welcome to Elliott Wealth Management Services' second installment of its 2024 mid-year economic update. This is Christopher Calandra. In the first installment, I gave my views on the economy as it relates to the markets and how we help our clients win with money. I asked Brett DiPasquale from the team here at Elliott Wealth Management to join me today to get his comments and thoughts and his input on what I had to say last week. He had a hand in preparing the information because the team helped me put this together. So he sort of knew what was coming, but at the same time, he got to hear my spin on it, how I wanted to explain things. And he and I work so closely together day in and day out. I thought it would be great if he joined me and could add to the conversation. So Brett, thanks for joining me on the second installment of the mid-year economic update.
Thanks for having me as always. Great to be here.
So you obviously know the presentation. You knew it even before I delivered it to the public, and then you listened to it as well. I know you had some notes, so I don't know where you wanted to start, sort of an open floor, but maybe you could begin by sharing with me some of your key takeaways as you reflected on what we presented to everyone.
Yeah, absolutely. I think starting out, we had talked all year about the concept of a soft landing, which you went over in the presentation, also which you went over in some of your podcasts during the beginning of this year. We got that right, which I think is a good thing. Over the first half of the year, we saw a lot of different issues come up, whether it be the presidential election, whether it be inflation, whether it be interest rates. All of those things kind of fit into that, to our cautiously optimistic stance on what would happen for the year. So as of now, halfway through the year, entering the second half, or into the second half, I should say, we're pretty comfortable with our position on really what's happened through the first half of 2024.
So we talked about, Brett, areas of optimism, right? So I'll pull up that slide that we could reference. And if you're watching this, presentation, I talked about optimism. The trend is your friend. You know, the market's been doing well for a while now, and that trend is your friend, and we think might continue. We have manageable inflation, a passive Federal Reserve. We're looking at possible interest rate cuts as the next Fed action. And we have low employment, relatively low employment, and we have a consumer that's hanging in there. When you think about the economy and the markets and reflect on things, I know you think deeply about such things. Is there anything you would add that you would say, yeah, you know, I know you're in agreement with this list, but is there anything you would add? If there was one thing you would add to this, what comes to mind?
Yeah, there's a couple things I would say. Optimism is always the key. But the big elephant in the room, like you went over in the presentation, is there's a presidential election coming up in here in a couple months. And generally, with a presidential election, that invokes a lot of emotion. So whenever you bring emotion into a conversation like the stock market, the economy, you have to remove the two. And it's very difficult to do. So we have to remember that when we're investing, it's typically for the long term. And removing emotion will allow markets to be more efficient, whether we're on one side of the political debate or on the other side of the political debate. When we're looking at the market and the political atmosphere, we have to remember that markets, like you said, hate uncertainty. They actually like bad news more than they like uncertainty. So it's not just the key factor of who is going to win an election, become president. It's going to be what is driving that new administration's views on such things as oil, foreign policy, all of those big things. So we have to take a look at also the balance of power in the Senate, the House of Representatives. All that's going to drive what policies will be made and therefore affect the markets. So that being said, another couple things that you went over is inflation. I think inflation is one of the big things that a lot of our clients and a lot of people are seeing day in and day out when they go to the grocery store, but also when they watch it on TV and on the news. So the news paints a certain picture of it, but it really is the feel that they get when they go out and they open their wallet up to spend money for themselves, for their families. So when something that important is affecting them, it tends to be a much higher issue to think about, especially in a political time like this, if that makes sense.
You bring up a good point, and I would say it's not exactly the optimistic it's not an optimistic notion, but I talked about net worth, how adjusted for inflation, net worth has not increased. In the first 3 years of President Biden's administration, household net worth only increased by 0.7% when you adjust for inflation. Under President Trump, the first 3 years adjusted for inflation, President Trump had benign inflation, just like President Obama did. The net worth increase was 16%. And so I talked last time about how this ties in for me why Americans are in a sour mood is that they haven't gotten wealthy over the last 3 years. They might have more money, but that money can buy about the same as it did the previous 3 years. So they didn't really make much way in progress in terms of net worth. What you're bringing up is a great point, and it didn't make it into the presentation formally, is that another key reason why people are in a sour mood is because a lot of the things that they buy every day or regularly, including food, or most importantly, food, has gone up a lot over the last couple of years. I think probably you could say, Brett, 20 to 30% on good range average, right? And that really is annoying and bothering the American public. For some people, it's budget busting and has really put them in dire straits. For other Americans, they could afford it and they could spend it, and they are, because consumer spending is pretty good, but it really doesn't sit well with them. And it's a key part too of why they're in a sour mood. That's kind of what you were driving at, right?
Yeah, absolutely. And I also think that people are kind of conflicted on the subject because they're seeing good returns as of late in their investment accounts. As you mentioned, the indices are going higher. We're seeing record highs, and then we saw record high as of this recording yesterday. But at the same time, inflation has always been one of those things, as we as financial advisors have talked about how that'll affect people in the near and even in the long term. But now we're seeing it come to fruition. So we're seeing how it's really affecting people. But what I mean by they're conflicted is they're seeing good returns in their investment portfolios, but it's really getting eroded away by the inflation as that money comes out of their account, out of their wallets.
Yeah, and I'll add that anyone that owns a home or owns homes, they've also seen those homes appreciate quite a bit. And this started back, in the height of the pandemic. So starting in 2020, I mean, when you look at house prices, that's a key way that people have built wealth. And that wealth, even though home values going up is intangible because you can't really spend that money quite easily, I think that's generally helped people with their confidence over the last 4+ years because they do feel wealthier because they have an increasing amount of equity in their homes, generally speaking. So I talked about reasons to worry. And I don't know, let me ask you this, and I didn't prep you for this, so I might be ambushing you a little bit, but forgive me. I'm a little bit more pessimistic, Brett, than I've been in a while. I was really pessimistic during the pandemic. Like a lot of Americans, I felt the weight of what was going on health-wise, economically. It was a tough period for me personally, as well as professionally. I mean, the business thrived during that, but it took a toll on me. Since then, though, I've been generally optimistic and have had a pretty sunny outlook on things, regardless of who was president. Even when inflation was running red hot, I was generally kind of a cool customer. But I do feel like I'm moving the needle to the more pessimistic side. My question for you, the ambush question is, did that come across in the presentation, or was that more something that was just sort of in the back of my mind as I was collecting my thoughts in preparation for the presentation and actually delivering the presentation?
I don't think it came across in the presentation. I think it was laid out in a way of both pros and cons to each side of it, both the optimistic and the pessimistic side. But to your point, there is a reason to have the needle swaying towards the pessimistic side with all the influences out there right now, with the amount of information that we clients society has access to now with their phones, with the internet. I feel like by having so much information at our fingertips, it tends to sway that needle towards the more pessimistic side. And also too, when you're talking about the US debt approaching $35 trillion, $728 billion per year to maintain that debt. I mean, those are big numbers, and they're incomprehensible numbers to most people. So, yes, I see what you're saying. I don't think that it came across pessimistic. I think it was a nice balance, and I'm not just saying that because I'm sitting here with you.
So you brought up a good point that was not part of the core presentation. So I focused on the U.S. Spending in fiscal 2024 is going to be about $1.6 trillion more than what they bring in. So the government's spending about 1.6 trillion more than they're bringing in revenues. And that's about 25% higher. So that would be the same as a business spending 25% more than they bring in revenue, or a household spending 25% more than they bring in. Like you make 100,000, but you spend 125. I think most people, most of the time, would agree that that's a problem and probably isn't sustainable. If you did that year in and year out, there'd be a big price to pay. And then we talked about the debt, that the debt's 33.17 trillion as of 2023. It's growing by 1 trillion every 100 days. That means it's projected to grow by about 3.6 trillion over the next year. then that's about an 11% increase. And increasing the debt by 11% a year consistently, and we have been increasing the debt, I don't know the percentage year over year, but the debt has been growing a lot. If you're watching this or you have the presentation in front of you, there's a graphic that just shows the gargantuan increase in debt over the last couple of years, especially, but it's been an ongoing problem. What I'm driving towards, though, Brad, is you mentioned the debt service, and I didn't touch on it, but you put forth an important statistic. So if you're listening to this, appreciate that the government finances this extra spending by borrowing money. And when they borrow money, of course, they have to pay on the debt. And the interest cost on the debt has been growing over the years because we have more and more debt, which means more and more interest is being paid, more interest payments is being made. And then more recently, with interest rates going up in the economy, where we used to have interest rates that were approaching zero, and now what's the average mortgage, Brad? 7%, something like that?
Right.
That the service of the debt has also increased from the US because we have more debt, but that debt is also more expensive on balance because of the higher interest. So I know I'm being long-winded, but you said, what's the statistic you threw out in terms of the cost of borrowing?
$728 billion per year.
So when you look at what the spending is for the US government, 728 million of it is just to going to service the debt. That would be the same as if you had big car payments or student loan payments or credit card payments or some combination thereof. And that too has grown a lot because, again, increasing debt in total, but that debt has also become more expensive over the last couple of years. And I think, Brett, and you could maybe verify this statistic, otherwise we could get back to our listeners on this, is that I think it's grown. It's traditionally been about 3% of gross domestic product, meaning that for a long time, even though the debt was going up, the US economy was growing. And so the relationship was usually about 3%. So if you looked at the total output of the US economy and you looked at the debt service, it was about 3%, which isn't so bad, probably manageable. That's part of the reason why I never viewed it as a key area of worry. But now that's doubled to 6%, and it's projected to continue to go up. And that puts a significant strain on things. Have you seen that statistic? Does that sound right to you?
Yeah, that sounds pretty close. Absolutely.
Yeah. All right. So what do you, we put together a slide. If you're watching this, I'll jump to it. Or if you're listening, Brett and the team put together a slide on some of the things that we're hearing from clients. I touched on one of them, Brett, when I talked about de-dollarization. Have you gotten any? I had at least 3 clients, maybe a couple more, reach out to me about de-dollarization. Has anybody reached out to you with that specific topic as a worry or questioning?
I've had a couple of them. It hasn't been on the foremost mind of people that I've talked to, but the ones that are really educated with the subject and interested, yeah, we've talked a little bit about it.
All right, good. So the first question that the team had come up with was, how will the 2024 presidential election impact my portfolio? Are there any special preparations your team is making? I'll answer, and then you could chime in, Brett. As I said in last week's presentation, we are watching it very closely. It's a crazy, crazy election season. The stakes are high. Emotions are very high. There's a lot of unprecedented, new, unique aspects to this. So it's something that we want to watch very closely. But historically, presidential elections have not really impacted the market. Even with all the craziness just in the first half of the year, the market has been thriving, at least based on market indexes. So most investors are not overly concerned to the extent it's having an impact on investments. So we don't think it'll probably have an impact on your portfolio. Once we have a new president, that removes some of the uncertainty that Brett and I have talked about already, because we'll know who the president is. And when you know who the next president is going to be, you probably know what their policies are going to be, generally speaking, at least directionally, what they're going to emphasize and what they're going to try and change or improve. And if you think about it, Brad, before I get your comments, if you look at the last couple of presidents, when President Obama was elected way back in 2008, the market did very well after he was elected. Now, that was also a time of unusualness because it was coming on the heels of the Great Recession. Actually, we were in the midst of the Great Recession. But when President Obama was elected, the market did very, very good, not only during his 8 years in office, but even in the early going after he was elected. And when President Trump, that was the next president elected, was elected in 2016, the markets did very well, not only during his 4-year term, but also in the early going after he was elected. And the same thing happened with President Biden when he was elected in 2020. Unusual circumstances with the pandemic still going on, but the market has done well. President Biden's first 3 years in office, the market returns weren't quite as good because you had 2022, which was a bear market year. But overall, the market's higher during the first 3 years of his presidency than it was at the beginning. All this to say is during each of those three instances, and I was in the business at the time, I know you were too, you're an experienced guy, is there were people saying, oh my goodness, this person was elected, everything is going to fall apart. And whether it was President Obama and President Trump or President Biden, and they were all very different, and the economies and the world conditions were unique in their own way, all three times when you had an election, the market behaved just fine, including in the short term. So our base case, to continue with that theme, is, the market will do well as long as the economy and other conditions do well. And regardless of who the next president is, the market will probably be okay, including in the short term. What do you think?
Yeah, I definitely agree with that. I think it all comes back to what we already talked about, the uncertainty and the predictability of the markets. And I think one of the special things that we have at Elliott Wealth Management is our process to monitor these things going on. So as you know, we have the monthly investment committee meeting where we review investments inside of our portfolios. We review the economy, all of the kind of things that are affecting our clients. So we are in a position and have a process to view what's going on relative to the election, to the economy, all that good stuff, and make changes when and if necessary. So that is a great benefit for us to have that process in place for our clients.
Yeah, I'm glad you brought that up. It's a key ingredient to the work that we do. It largely happens behind stage, if you will, but that allows us to communicate with one another, gather different points of view, feedback from clients, things we read, things we heard, our own life experiences. We put that together. We kick stuff around, very open, honest, sometimes even arguments, but really good, open, healthy debate. And I think it's a key ingredient to some of the success we have. The second question was, rates have remained higher for longer than we've expected. What do you think would be a good time to refinance the house we bought last year at a high rate? So I'll go first and say that expectations in the market is that interest rates will be lower in the future than they are now. As an example, if you look at CD rates, 1-year bank CD rates, they're higher now than if you took a 1-year CD, you get a higher interest rate than if you locked in your money for, say, 2, 3, 4, or 5 years. Because the expectation, and this ties into our commentary on the base case, soft landing, and the Federal Reserve, is that at some point, the next cycle is going to likely be interest rate cuts and interest rates declining. So there probably will be an opportunity if you have one of these newer, higher interest rate mortgages to refinance at a lower rate. The timing is tough. I think refinancing this year for most people, of course, every situation is individualized, but I think generally 2024 is not the year to refinance. My guess would be the second half of 2025 for most people would be a good time to take a strong look at it, but that doesn't mean that you shouldn't be paying attention between now and the second half of 2025. But I think over the next 12 months or so, probably not a ton of opportunities on the refinance side to get a lower interest rate. But the second half of 2025 is shaping up to maybe be a better period to pull off that kind of thing. What do you think about that answer?
Yeah, I agree with that. I think the one word that comes to mind for me when I think about this and talking to clients about it is optimism, right? Because if you're in a mortgage right now, you bought a new house last year or sometime in the recent future or recent past, you're locked in at one of those higher interest rates. So optimism, as in we talked about in the presentation, as rates start to come down, it really puts you in a great wait and see position where you can wait out what those rate cuts might be and then look to refinance at the right time for the right price and the right rate. So I think it's a great reason to have some good optimism in that space.
Yeah, and I'll do some promotion here if you're listening and or watching this, is that a recent Simply Financial podcast episode I did talked about the benefit on a 30-year mortgage by making a bi-monthly, make 2 payments a month instead of 1 payment a month on your mortgage, because that means you'll have 1 extra payment per year. So take a listen to that, because if you do that, if you did it right from the beginning of a 30-year mortgage, you reduce the 30-year term down to 23 years just by making 1 extra payment a year and systematizing it, making it very budget friendly. So take a look at that episode, because I think it ties into what we're speaking about, regardless of the interest rate, but especially when interest rates are higher like they are today. That's a good, friendly, systematic way to save yourself some money and reduce the mortgage term. Next question was about hot stocks. There's always hot stocks that are growing by leaps and bounds, and you can make some really fast cash. We at Elliott Wealth Management tend not to transact in that kind of stuff, because hot stocks oftentimes become very cold stocks. And there is a way that you could trade these things and make money, maybe make money hand over fist, but it is riskier. It can turn on you. You could also lose money really quickly. So as a general rule, when we're entrusted with client money, we tend not to chase hot stocks. Now, there might be some exceptions to that rule. And for some clients, we will engage in certain strategies if they want to take advantage of that. But I'm always cautious personally, as well as professionally, about chasing hot stocks. I am not a believer in sort of the greater sucker theory where, yes, I'm overpaying for stock, but I think I could sell it to somebody that's a bigger sucker than me down the line. So I think if you're listening to this and if you're attracted to that kind of thing, you might want to experiment with it. You might want to, have a little bit of a taste. Some people like the thrill of that kind of thing. But the core of what we do at Elliott Wealth Management, we're managing money for long-term sustainable success, being diversified, using best practices. That brings us away from hot stocks. There are always hot stocks. There's a few in the news today that are very hot and very topical, but I've been at this for 30 years. I could give you lots of history about previous hot stocks, some of which did very well over the long term and others that are not in existence anymore. So we're probably not the best outfit if you want to be a hot stock investor. Related to that was a question about AI, artificial intelligence. It's been all over the news lately. Is there anything you recommend in the space to take advantage in our portfolio? We have done that in our core portfolios. Now, there are a lot of artificial intelligence companies out there. There are also a lot of companies that are embracing and adopting AI technology, making them more efficient, carrying out their mission better, less cost, serving their clients better, reducing expenses. So this advantage is taking place across a wide spectrum of the public markets. So we have taken advantage of that in the broadest sense. We don't have any positions that are specifically AI, but again, in the indexes, in the portfolio, just by natural circumstances of what's happening, we do have a healthy position in AI, although it's not a single line item, if that makes sense. Brett, did I explain that okay?
Yeah, you did. And I'll just add one other thing to that, kind of piggybacking on that thought. So the S&P 500, one of the most recognizable indexes out there. People see it on TV every day. We own it in a position in our portfolio. Inside of the S&P 500, a lot of our clients have heard of the Magnificent Seven. So the Magnificent Seven being Apple, Amazon, Alphabet, or Google, Meta, Microsoft, Nvidia, and Tesla. So those seven positions make up 30% of the entire weighting of the entire index. So when we're talking about AI and we're talking about the hot stocks, maybe you've heard of some of those names that I just listed out. But inside of those, for instance, Apple just announced some interesting AI technology that they're going to be incorporating. So you might not own them individually inside of your portfolio, but you absolutely have a weighting to them inside of other ETFs, exchange traded funds, or mutual funds inside of your existing portfolio.
Well, your answer was better than mine. That was well done, Brett. Thank you. The last question, and we'll wrap up, is I'm retiring in a few years and the market is at all-time highs. What is a good way to protect our gains from a decline? I would say, in short, talk to us here at Elliott Wealth Management. We're a team that is very experienced, deep technical skills. This is our profession and we're very good at it. We're credentialed, licensed, all of that stuff. So come to us. I mean, this is an area of expertise for us. If you're a client, we've probably been working with you. We could review it, discuss it. If you're not a client, I would say come to us, because there are numerous strategies and ways to approach this so that you can retire regardless of whether the market is strong, weak, high, low, whether you're aggressive or conservative. Generally speaking, you could retire in a healthy way, regardless of market conditions, but it's an area that we could certainly help. You have anything to add to that, Brett?
Two quick things. I agree with everything you just said. With markets at an all-time high, and especially for folks, clients approaching retirement or approaching their distribution time, now's the time to take a look at what your portfolio is at and how to start distributing it. So sequence of returns is going to be a really big issue and a really big point to look at. So that just means if the market were to decline in the first couple of years of retirement, that can really affect someone's portfolio. So as you said, case by case basis, but always things to think about with markets where they are now.
Very good. So everyone, appreciate you listening and watching. Just to review, our base case is a soft landing, that inflation will continue to be not a big problem. We're at this plus 3% range. The Federal Reserve wants to get it closer to 2%. But we think that could be accomplished without ruining the economy, that we could, in the short term, avoid a recession like we've done so thus far. We have areas of optimism, low unemployment, manageable inflation, a passive Federal Reserve that probably is biased towards cutting rates down the line. And the trend is your friend. The markets The stock market has been on a good run, and we think that that's likely to continue. We're cautiously optimistic. We could finish the year higher than where we are today, using S&P, Dow Jones Industrial Average, various market indexes. So we're cautiously optimistic. But at the same time, we've outlined several things that we are worried about. That families have not built much net worth over the last couple of years. We have a federal financials that are not so good, a lot of debt, a lot of spending above revenues. We're long-term a little worried about dollar de-dollarization. And of course, we have this crazy election season that is upon us. But generally, we're cautiously optimistic. Appreciate you checking us out and listening in and watching to this presentation. We put a lot of work and effort into this, so hopefully you found it valuable and informative. I am very proud of this. I think Brett is too, that this is good stuff in our opinion. So appreciate you taking the time. If you want to talk about any of this, including how it might impact you, reach out to us, call, email, go to the website, elliottwealth.com. You could schedule a consultation, including if you're not a client, at the website. So let us know your thoughts. And once again, thanks for listening.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.